First thing I've got to put up, folks, is the disclaimer. VectorVest, I think, pretty much the only training organization in the stock market in the UK that's authorized by the regulator. So I have, although I may speak about shares in a moment that I hold myself, I have to make it very clear that although those are suitable for me, they may not be suitable for you. And certainly leverage positions in the stock market I have to warn you about. So what I do, folks, is that I do some intraday trading, not as much as I used to, of mostly the Dow in the afternoon, or what the spread bettors call Wall Street, and some forex pairs. I rarely intraday trading look much further than the cable, that's pound against the dollar, the euro dollar, and the Aussie against the dollar. Swing trades, looking for opportunities, 3 to 21 days in UK, US stocks, forex pairs, gold, oil, and US treasuries. And then this is the sort of portfolio that I talk about at our VectorVest Q&A meetings, which are core trades and stocks that last 2 to 6 months. And then I have, because I'm 65, I've got a portfolio focusing on yield as well. So, and I believe we need 3 things, folks. We need a method, and for me, that's a fusion of VectorVest and the Wyckoff, a technical analyst by the name of Richard Wyckoff, low risk setups. We need to manage our money really well, and that we talked about a few minutes ago. The clusters are absolute hell. If you have 3 bad ones in a row and you're betting 5% of your account in any one trade, you're down 15%, and 15% will start to rattle you. And if you work for a fund manager, you'd be out in your ear. And of course, we've got to manage yourself really, really, really well. And the things that show us how to make some money are risk to reward, how much money you make when you're right, how many times out of 10 you are right, and then of course commissions and spreads. And in stocks in the UK, we have to pay stamp duty as well. So that's the whole concept of expectancy. And expectancy simply means that your system must make more when it's right than it loses when it's wrong. And that's a word that's been sort of stolen from the gambling industry, expectancy, because the casinos have worked out the expectancy of the casino games. And the casinos, as you would imagine, have written a set of rules for all the casino games, which means that they make much more than they lose. And they built cities on it. The dude putting the £1 coins into the machine has got a negative expectancy system. The longer he stays, the more broke he becomes. So this is something you may have worked out on your own. And the discipline is summed up by Mike Tyson. You know, everybody's got a plan until they get a punch in the mouth. Okay. And Thero asked me, in the morning. This is something that I think about in the morning every day. It was a wonderful movie. It got an Oscar for Clint Eastwood and Hilary Swank. It was called $1 Million Baby. It was a boxing movie.
Yeah, it's a good movie. I've seen that one.
Clint Eastwood ran this gym, and he didn't like female boxers in the gym, and he gave her that long Clint Eastwood stare. And he looked at her and he said, "Are you working the bag, or is the bag working you?" So that's a good question to ask yourself every morning, folks. Are you working the bag, or is the bag working you? So what I do in any market, the setup involves establishing trades at the danger point, where the risk is least and the profit potential is greatest. Now, I took that out of Richard Wyckoff's little book that he wrote in 1930. But I have 4 theories. I don't know what you think of these guiding thoughts. G-U-I, did I spell that right? Guiding thoughts. First one is the good trade is the hard trade. Now, this does not mean that it has to be difficult. It just means that it's difficult emotionally to execute. You don't have to be that bright. In fact, I think probably the thicker you are, the better. The good trade is the hard trade. Thought number 2, I fade the short-term trend in the direction of the long-term trend. So if I get my little pen out, if we've got a long-term trend, series of rising bottoms, I want to fade this little bit. Okay, that's the short-term trend. This is the long-term trend. On VectorVest, we have we actually put a word to the trend, two words to the trend every day, short-term and the long-term trend. I fade the short-term trend in the direction of the long-term trend. Thought number 3. This will revolutionize your trading. I place my entries where the masses place their stops. Okay, think about that. I place my entries where the masses place their stops. And thought number 4, I am correct with big positions and wrong with tiny positions. And that's all about adding to winners. Now, there's no doubt that that is difficult, and I have no problems if you scale out. But folks, if you do scale out, the half that you hold, get your stop to entry, and you need to let that half run. If you don't let that half run with the stop at entry, with a very tight trailing stop loss, that scaling out is not a winning proposition. Now, if you want to make big money, you've got to get to the point where you can add to winners. And both myself and my trading partner, a big fella called Tom Hogarth, we've proved this over and over and over and over again. And that's what we do. So Mr. Wyckoff says that you can make a fortune trading springs, upthrusts, and sweet spots. They are the cornerstone of the Wyckoff method. Again, I take that out of his book. And as I've said in the preamble, adding the VectorVest fundamentals in the stock market and the direction of the overall market pushes the hit rate up markedly and also pushes the risk to reward up markedly. So the stock market, I firmly believe, is easier because of that reason. Now, there's no easy money anywhere, but nevertheless, I think the stock market is easier. So what are we looking at? We're looking at, to find a trend, a series of rising bottoms, and you all know you can put a trend line on there. There are 3 types of trends according to Charles Dow. And Charles Dow said that if you have a higher low, and that higher low is higher than this last top, this higher high. In other words, there's a gap in here. It doesn't come back. Again, call that a positive break. Then you've now got a fast trend, folks. And in a fast trend where that bottom is higher than that top, that's the only place where I actually use breakouts. So if I see a fast trend and the market, in fact, doesn't break, doesn't come back to that last top, then it's okay to actually buy a breakout, or it's okay to add to a position in a fast trend. Now, that's the second type of trend is what Dow called a normal trend. And the normal trend happens most of the time where the market comes back to that last old top. Now, why does it happen? Well, folks, you're going to have to read up on behavioral finance for that, because it's called a recency bias. And the behavioral finance chaps have got long hours to kill in universities. So they've come up with many thousands of terms to actually try and put a handle on what we do. It keeps them off the drink until a respectable hour, I suppose. So markets come back to that last old top, and that, folks, is a very good place to enter somewhere down around here. And that's what Wyckoff called a sweet spot. I use it all the time. Now, you'll be saying out there, well, everybody knows that. But folks, I assure you that it's quite difficult to do. Because when the market is pulling back, everything in your head is saying, hey, this is not a pullback at all. This is a change in trend. So it takes a little bit of, again, testicular fortitude to do it. And then, of course, the last type of trend that Dow talked about is what he called a creeping trend, where this low impinges on this high. And that is either a reversal or the market going into a consolidation. So when you see this, you need to be careful. So I want to be trading in markets, trying to make a buck in markets where I see a fast trend or a normal trend. When I see a creeping trend, time to be careful. It could certainly break up again, but stay in the moment and do your best to avoid that. Now, volume is great, and I've spent a big part of my life looking at volume, and I could spend 3 days talking about volume and a thing called market profile. I don't know if you guys have used market profile, but it's just another way of looking at volume. But pullback should happen on falling volume. Simple as that. And I've got this is out of Wyckoff's book. I've had an artist add the color because it was in black and white. But if you do trade a breakout, folks, that breakout should occur on rising volume, and it should pull back on falling volume. And you want to buy there at the danger point. So let's have a look. That's a sweet spot. Simple pullback to here. And I'll define that and show you some examples of that in a minute. And really, for the sweet spot, I'm looking for a entry point somewhere down around there. And this chart, France and South Africa, I think that is Harmony Gold Mine, actually. The chart is really old. Harmony doesn't exist anymore. It's a part of Sibanya, I think. So this pulled back to this area, and then it started to move up the page. The Fibonacci people would call this A, B, C, and D. Any harmonic pattern people watching?
David, just a very quick question on that our traders in the room would be interested in. You know the part where you're saying that it falls back to the resistance point where you've drawn, which is C, right?
Yeah.
Our guys usually be interested in how do you quantify that thing consistently where you have drawn the high part, the resistance where it drops to? Or is it just based on discretion that you find that high part where it comes back to in C?
Yeah, just draw a line.
Okay, that's what you. Okay,
just draw a line.
Right.